Welcome, everyone, to this episode in our series covering real estate tax write-offs here with Michael Plax, Real Estate Tax Black Belt. All these episodes kind of come together, and this is a great episode, S Corporation's episode 16, which builds upon and integrates with so many other items. And we will discuss benefits for real estate investors and gotchas and execution with regards to S Corps for real estate investors and flippers. Michael, can you please take it away? What are the benefits of S corporations?
Of course. And as Bernard mentioned, we are tying to other episodes. The one before, our previous one was specifically about LLCs and entities. And I hope that we made it very clear with Bernard on our last episodes that LLCs do not bring any tax benefits with them. But then we said, except if they are an S Corp. So S Corp is topic for today, and we are starting with the question that everybody asks online and everybody answers wrong. Because the question is asked, what is better, LLC or an S Corp? And this is incorrect question. So no matter how you answer that, it will be wrong answer because this is a wrong question. You don't compare LLC to an S Corp. Why? Because what you create always is an LLC. Now I said always. I'll quickly put an asterisk and saying under some circumstances, not your accountant, but your attorney can recommend that you create a corporation instead of LLC or something else. We are not going there. 99% of the cases, what attorneys will recommend for real estate investors will be an LLC. And what about S Corp? S Corp is an election that you put on top of an existing LLC. So you still create an LLC, just like for any other situation. But then you turn around and tell Uncle Samus, hey, could you please treat my LLC as if it was an S Corp? So what S Corp is it's an LLC that identifies as an S Corp by filing a very simple form with the IRS. So what it does then is it's an LLC which for tax purposes is treated as an S Corp. And what our first portion of the slide says is the benefit is there are tax benefits for flipping but not for rental properties. And when we say flipping, we also include in flipping wholesaling and realtors, basically any type of hands-on business where you generate active income, but not rental properties. Why is it so, Bernard?
So S corporations, which is a tax concept, an election made with the IRS, does have tax impact. And depending on what you're doing, that tax impact could be favorable or unfavorable. An S corporation is not disregarded, and for tax purposes is viewed very much as independent of its owners, which means, number one, its owners are expected to take a W-2 salary for their participation in the business. Now that creates benefits and a compliance burden. What are the benefits? Well, an LLC that's a disregarded entity or just a partnership will create self-employment income and self-employment income tax on the full income of the business. In contrast, an S Corp, which is viewed as independent of its owners, S Corp income does not create any payroll or self-employment tax liability. But you're expected to give yourself a salary, and on the salary, there will be employment tax. An illustration is very helpful. So suppose somebody is doing flipping and they're using an LLC without an S Corp election. And suppose they made $200,000 of flipping income. Without an S Corp election, they would pay ordinary income tax plus payroll tax, self-employment tax on the $200,000. And that could be a big tax bite because on most of that money, it's going to be about 15%. In contrast, suppose this LLC made an S Corp election. Well, now the LLC, that LLC, or today an S Corp, has netted $200,000 in income. Well, it's subject to income tax, but zero self-employment tax. Now, if we stop right here, this sounds like an amazing benefit. You just saved $30,000 by forming an S Corp. And that benefit is very, very real, but you're probably not entitled to the full $30,000 tax benefit. And I guess I'll hand it over to Michael to elaborate why that is.
Before elaborating, I want to make one point very clear. When we are talking about flipping, wholesaling, being a realtor, all this type of income, it's subject to two taxes, not one. There is income tax and there is self-employment tax. Both apply. S Corp cannot do anything about the income tax portion. This is very important to understand. So all the savings for S Corp come on the self-employment tax side. Income tax stays exactly the same. So what we are attacking with the example that Bernard just described is self-employment tax. And he showed us two extremes. So if that on 200 we are paying self-employment tax, it's 15% of the 200, which is about 30,000. The math is not accurate. Those of you who happen to know details of how that tax works will immediately object and be correct, saying is that we are not giving technical details. Yeah, we're not going into technical details. It's not really 30,000. It's less, but we are not going to talk about specific of calculation. For simplicity of example, we'll just apply 15% to the whole 200 and say it's 30,000 tax. The other extreme, Bernard said, is would be, okay, let's do it through S Corp. There is no self-employment tax. Wonderful. Just saved ourselves 30,000. What could be a problem? This is the problem. He looks at it and saying is, I don't like your game. I don't like you just wiping out the entire 30,000. Let's have a compromise. The compromise that he says is you are required to take some of that money as salary through W-2 payroll. On that money, he will get his 15% from you. So if we take that 200, maybe 100 of that is salary, the other 100 is not salary. So on the 100, which is salary, you still pay self-employment tax. You are getting no savings. The other 100, you are saving self-employment tax. And our calculation said, how much tax we can save on 100? 15,000. Again, the calculation is not really correct. In that example, it will not be 15,000. But if we are talking about magnitude of savings that we can generate from this game of an S Corp, it will be, can we save ourselves 2,000? Definitely. 5? Yes. 10? Yes. 15? Maybe. Can it go higher? Maybe it's some situation. But early on, Bernard said something interesting, which I expect most of you didn't pay much attention to. He said, under some circumstances, it will not be beneficial. How, when, we don't have time to go into technicalities, but the point he made is extremely important. For all of those savings that sound extremely attractive, you need to have the right set of circumstances. Example of the right set of circumstances would be you are a high volume wholesaler who is making 200 and this is your full-time job, nothing else. Okay, can you play that game and save a lot of money on self-employment tax? Yes, that's probably an ideal situation for S Corp. Where you cannot do that? Well, let's say that you have a high-paying job as a professional engineer, attorney, physician, nurse, something like that. And you're making good money, and you are also doing some wholesaling on the side. Can S Corp save you some money there? Maybe, and maybe not. This is a situation which is tricky and requires careful calculation. But for both situations, where benefits are definitely big and benefits may not be big or may not even exist at all, the key is he requires you to have a formal W-2 payroll. If you don't do that and people saying, oh yeah, I have a payroll, every month I'm taking 2,000 out of my business account and moving it into my personal account. No, this is not W-2 payroll. This is taking money out of your business account. For LLC, which is not an S Corp, it's perfectly fine. For an S Corp, you need W-2, just the same styles as if you worked for a corporation. So there are forms, there is withholding of taxes, there are reporting forms, all of this hassle and cost. This is not a good do-it-yourself project. You need to outsource it, hire a payroll company, or maybe have your accountant do that service if they provide it, but you need help setting up payroll. That's not only hassle. You also have to prepare S corporation tax return, which is not optional. This is complicated, especially lately with additional compliance requirements from the IRS. And if you hire professional help, which is almost unavoidable when you deal with S Corp, that is expensive and will eat part of your savings. And lastly, you need to remember is there are a lot of restrictions. We had an episode, a few episodes back, episode 6 was talking about business vehicles, and we talked about deductions. Guess what? In order to utilize that deduction with an S Corp, you cannot deduct mileage. You cannot deduct mileage if you don't set up a special provision, which is called an accountable plan. And that's
assuming the lease is in your own name, not in the S Corp.
Okay. So that second part of execution, since you already started, and I wanted to ask you to complete it anyway. Go ahead, Bernard.
Oh, okay. And I should say, I reword that ownership. Right. If you take an S corporation, now we have essentially two separate entities, and a lot of the expenses that were more easily mixed and mingled between personal and business were more easily done without the S Corp election. With the S Corp election, now that it's viewed as an entity apart from yourself, if you are personally incurring various expenses on behalf of the business, in order for the business to get a deduction, you have to have a formal accountable plan in place. It's not a big deal, but it's very, very important. In the absence of an accountable plan, those deductions are technically lost. Personal expenses.
I disagree when you said it's not a big deal. It is a big deal because those deductions will be lost. You know, if you have 20,000 deduction for mileage that you used your vehicle partially for business purposes for your S Corp, here you are, you're losing 20,000 deduction. That could be a big deal.
Oh, and absolutely. It's a big deal in terms of the magnitude. I say this is one of getting an accountable plan in place should not be a big deal. Unfortunately, I see very little mention of it online. We see all sorts of stuff about S Corp benefits. I'd say the ratio of mention of S Corp benefits versus accountable plan is probably 1,000,000 to 1. But it's not a huge deal to get an accountable plan in place. And that's going to be key because effectively, again, a personal today, since you're an employee of the business, there used to be miscellaneous itemized deductions for personal expenses. incurred for the business, those are gone. The only way to preserve those is with an accountable plan.
And that completes our episode because we just finished benefits, gotchas, and execution. And we will see you guys on the next episode. Next episode, we are going to talk about fantastic vehicles that are available for real estate investors, self-directed retirement accounts.
And
Thank you for attending. Thank you, Bernard.
Thank you, Michael. Thank you, everybody. See you on the next episode.